Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Hey guys, I am a little bit late here. Somebody decided to ring my door and try and sell me Windows just before, and I came back and I'm like, oh crap, I only have 30 seconds. It's okay. Hey, look, I said that they were gonna sell. Look, they are selling. Oh, are they selling? Oh, are they selling? Okay, let's get down to it. Okay, Nick Timmeros, Fed holds rates steady. 12 officials pencil in one more hike this year. 7 are ready to pause. Okay, that is not what I expected at all. The median participant projects 2 cuts in 2024. So that is definitely more hawkish than they were expecting. So this is like what I was saying earlier, right? I said probably what they come out with is going to be more hawkish than the current market pricing. Can you know things that will predict future orders that aren't correctly priced into the markets? Yes, you can. You might not have the balls to trade on them, but you can. So this is interesting, though, that, well, the initial move was pretty woo. But so far, the decline actually is not that much in the treasuries. This could just be the start, though. Like, I'm gonna sim trade this. Probably a bad spot to build a position out because of that big order is gonna turn things around. Yeah. Let's try right there. Okay, now the next thing I want to see is the statement comparison. Oh, nothing really too big in their change. They changed from moderate to solid pace, robust to slowed. Job gains have slowed in recent months, but remain strong. They decided to maintain the target rate. No fill there yet, eh? Okay. Well, second order never got hit, but... Four, 3, 5 is about right. I'm so tempted. No. I'm not going to do it. I'm not going to do it. It's too much risk there to do it on my live account. It sure seems to me that the flow is going to continue being short here, though. Oh man, the S&P just got savaged, man. 20 points. Okay. So where we got in the SPOOs? They get below 44.62. That's where the previous downside was. Median unemployment rate projection dropped to 3.8% for 2023 versus 4.1% previously and 4.1% for 2024 to 2025. The median core PCE inflation rate projected from quarter 4 ticked down to 3.7 from 3.9. Here we go. I don't know. Oh, like they filled me really quickly. This is gonna fly back in our faces, isn't it? Even though estimates of the long run rate didn't rise, the median FOMC participant has inflation back to target in 2026, the unemployment rate at the long run rate, and the economy expanding at trend, and a nominal Fed funds rate that's a shade below 3%. Brannigan Barrett says long bonds equals the Widowmaker trade. Okay, so something that I learned just before hitting into this was that, like, apparently the CTAs are all short. So CTAs just got paid. That's why I'm kind of like, this could flip back in our faces. I gotta be careful here. But like the pullbacks at the very least are going to be a little ugly. Did Fed I told you so? I kind of feel like the market should have seen this coming, right? Now just keep in mind that sometimes the press conference paints a different picture and things completely switch, right? But I definitely I said it outright in the stream this morning, right? The projections that the market are expecting are unrealistic. Most media was too optimistic. You know, I wasn't even basing it off of that. I was just looking at the valuations that the market was giving based off, you know, what interest rates they must be thinking they're going to get. That what interest rate equities must be thinking they're going to get based on valuations was just silly. Like, how do you have a quote unquote soft landing, everything's hunky dory, you know, and the economy continues expanding into next year, and meanwhile you reduce rates? It's just not going to happen. Almost. Thanks for sharing. I don't know. I don't feel like I'm kind of like, I don't know if I gave you guys too much helpful today or not. Well, this thing right now, this sim trade that I'm in seems to be going okay. I'm not, you know, I kind of wish they had gotten those fills up there. Be a lot happier. Man, it's been sitting there at 0.4 for a while. I'm surprised. I'm surprised they're able to hang out there. Wish the Fed is right. Well, I don't know if the Fed is making it enough of a statement about something for me to say they're right or wrong. Curious that they don't want to sell O4. Kind of seems like the Japanese yen can't move much further. The dollar is kind of stuck. Like, I see the opportunity for it to go lower, but it's just not. Yeah, Powell will be speaking in about 15 minutes. You're short 04? 04 in the 10-year? It's not a... I don't know, man. I hate holding positions into the... Oh, okay. You're messing with me, aren't you? Because you know how much I hate the press conference, man. Like, just the most bizarre things happen in the press conference sometimes. So I'm just hearing that they were expecting 100 basis points of cuts next year, and they're getting 50. Dot plot of rate projection shows policymakers still foresee one more hike this year, but 24 and 2025 rate projections each rose by half a percentage point, a signal the Fed expects rates to stay higher for longer. Oh, you mean like they've been saying for the past year? Who'd have thunk? 12 of 19 policymakers on the FOMC expect one more rate hike this year. I was uncertain. In fact, when we looked at when we looked at the FedWatch tool, they were like, the market seemed to be uncertain. It was like 40% chance that they didn't raise again this year. Okay, so that's definitely different. When I put that into perspective, like the amount of change that we actually got compared to like what the market was expecting before, I'm kind of surprised they're not going further. Seems to me that they should have more fuel, but I guess they're only willing to make the knee-jerk reaction and then rebalance before he starts speaking. And this could be something where maybe they continue down after after tomorrow. They didn't raise rates. They 12 of 19 see one more rate hike this year, though. And the median projection was basically rose by half a percentage. So like on the dot plot, they were basically saying, oh, we'll reduce interest rates 4 times next year. And now they're saying we'll reduce interest rates two times. So, curiously enough, the hawkishness did hit gold and silver, but they did not erase the gains that gold had made earlier in the day. So, that's interesting, isn't it? Still weren't able to get below like my price point. It's messing with me again. It's so funny when it does this. I'm glad that I'm not live trading this. Well, they're kind of chipping away at it. Like the selling, we're getting another wave of selling coming into the treasuries. They're chipping at it, but iceberg at 0.4, huh? Push back. I don't know if this one's gonna work out, guys. Really, I should, when it was like at 0.6, I should have loaded up. Then I could have dumped it here at break even, and then, you know, my position would be up here instead of here. Let's see, we get some hot reactions here. Mohammed A. L. Arian, as expected, Federal Reserve left interest rates unchanged. The decision came with significant and unusually large revisions and projections that are sure to have markets and analysts characterize today as a hawkish pause. They will also cement even more the notion that rates will be high for longer. The press conference in half an hour will be interesting. Yes. Interesting is a word. Jason Furman, I would be very surprised by 2 hikes this year, but I think one more is likely and very weakly lean towards expecting another one in the first half of next year. Joseph Wing, more and more FOMC participants are thinking that R star has shifted to higher. Median is still 0.5 real for now. They're like, you want another chance at it, Seth? Okay. I guess if you force me into it. Okay, they gave me that. Well, looks like I might have to wait until the press conference before I get any kind of fills. Put them over here. I'm just going to chill here. I feel like I should be saying something, but not really actually seeing too much commentary coming through. Not. Man. So I have '08 as a key point here. It has kind of chilled there a little bit. That's using my inventory cost basis. I'm kind of expecting it to come back down, but it's not. It's just chilling there. And in fact, I'm still seeing the volume in the treasury sell, and it seems like it's the Japanese yen that doesn't want to cooperate. So. Okay, here we go.
Promote maximum employment and stable prices.
Fed's
for the
pal says
American
we're
people.
squarely focused on the dual
We
mandate.
understand the hardship that high inflation. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone.
Hopefully that's loud enough for you guys.
We will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead,
Oh no.
we are in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate. Our decisions will be based on our ongoing assessments of the
How much risk can I afford to put on this case?
outlook and risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. And so far this year, growth in real GDP has come in above expectations. Recent readings on consumer spending have been particularly robust. Activity in the housing sector has picked up somewhat, though it remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP, committee participants revised up their assessments of real GDP growth. for this year now at 2.1%. Participants expect growth to cool, with the median projection falling to 1.5% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to work gap has narrowed, labor demand still exceeds.
E-mini completely retraced the down move.
FOMC participants expect the rebalancing in the labor market to continue.
Did I miss some? Did he say something there that made me be like, actually, this is dovish? I didn't hear it.
In the SEP rises from 3.8% at the end of this year to 4.1% over the next 2 years. Inflation remains well above our longer run goal of 2%.
Joseph Wang on Twitter asks, is Apple sponsoring this FOMC? Because he's got an Apple
over the 12 months ending in August.
Notepad there.
And that excluding the volatile food and energy categories, core PCE prices rose 3.9%. Inflation has moderated somewhat since.
Now, Jimmy Iorio has a good point here. Fed has a very poor history of predicting what they're going to do any time frame more than a few weeks out. I have little interest in what they think they are going to be doing in 2024.
Forecasters, as well as measures from financial markets. Nevertheless, the process of getting inflation sustainably down to 2% has a long way to go.
This is like a zoo, man.
For total PCE inflation is 3.3% this year, falls to 2.5% next year,
3 more,
and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. We see the current stance of monetary policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses. Range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently inflation down to our 2% goal.
This is actually something else going on, but relevant.
FOMC.
There is a debate in the upper ranks of the House GOP about trying to move the continuing resolution debate away from spending levels and towards border security. This is McCarthy's preference being echoed by other senior Republicans. In other words, they're saying, okay, we won't cut the deficit a ton, but instead we'll force you to have to defend the border.
At the appropriate level of the federal.
That might be a better win for them. I don't know.
6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. Compared with our June summary of economic projections, the median projection is unrevised for the end of this year, but has moved up by 0.5 percentage point at the end of the next 2 years. These projections, of course, are not a committee's decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and
I need to eat something, man.
the balance of risks. Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. In determining the extent...
You kind of wonder how much of this is actually him speaking and how much of it is just the dollar retracing.
The committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to
Getting another... It's too many people watching it today, guys.
keeping longer-term inflation expectations well anchored. It is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. What makes the committee inclined to think that the Fed funds rate at this level is not yet sufficiently restrictive, especially when officials are forecasting a slightly more benign inflation outlook for this year? There's noted uncertainty about policy lags. Headwinds have emerged from the looming government shutdown, the end of federal child care funding, resumption of student debt payments, things of that nature.
So I guess I would characterize the situation a little bit differently. So we decided to maintain the target range for the federal funds rate where it is at 5.25% to 5.5%, while continuing to reduce our securities holdings. And we say we're committed to achieving and sustaining a stance of monetary policy that's sufficiently restrictive to bring down inflation to 2% over time. We said that. But the fact that we decided to maintain the policy rate at this meeting doesn't mean that we've decided that we have or have not at this time reached that stance of monetary policy that we're seeking. If you looked at the SEP, as you obviously will have done, you will see that
Summary of what happened? Sure. So
that it will be appropriate for us.
the projections were more hawkish than anticipated, as I had predicted in our morning session today. They were about
We're not making a decision
50 basis points
to
higher
about that question.
for the next 2 years than before. And the majority of participants think that there will be another of the FOMC participants. I think it was 12 out of 19. Believe that there will be another rate hike this year. However, since he started speaking, we've retraced a great deal of the downside action.
We welcome that, but
And that may just be dollar correlations. I don't know.
to reach that conclusion.
And just
Doesn't seem like he's said anything all that significant yet.
shallower path for interest rate cuts and the need for real rates to be 50 basis points higher.
Right. So I would say it this way. First of all, real interest rates are positive now. They're meaningfully positive. And that's a good thing. We need policy to be restrictive so that we can get inflation down to target, okay? And we're going to need that to remain to be the case for...
Well, they're kind of breaking out of their range a little bit.
Remember that of course, the SEP is
Not really going, though.
is negotiated or discussed really as a plan. It's accumulation really.
Still kind of reading the volume is negative, though.
From 19 people, and then what you're seeing are the medians. So I wouldn't want to bestow upon it the idea that it's really a plan. But what it reflects, though, is that economic activity has been stronger than we expected, stronger than I think everyone expected. And so what you're seeing is this is what people believe as of now will be appropriate to achieve what we're looking to achieve, which is progress toward our inflation goal, as you see in the SEP.
Thanks. Let's go to Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions.
How would you characterize the debate around another hike or holding steady? Is it discussion around lag times, fear of too much slowing, too little slowing? Could you walk us through what this disagreement was about at the meeting?
Yeah, so the proposal at the meeting was to maintain our current policy stance. And I think there was obviously unanimous support for that. But this, of course, is an SEP meeting, and so people write down what they think. And you have some, you saw, I think 7 wrote down no hike at this meeting, or between now and the end of the year, and I think 12 wrote down another single hike in one of the next 2 meetings that we have between the end of the year. So it wasn't like we were arguing over that, people just stating their positions. And really what people are saying is, let's see how the data come in. You know, we want to see, you know what we want to see. We want to see that these good inflation readings that we've been seeing for the last 3 months, we want to see that it's more than just 3 months, right? We want to see, you know, the labor market report that we received, the last one that we received, was a good example of what we do want to see. It was a combination of across a broad range of indicators, continuing rebalancing of the labor market. So those are the 2 things. Those are our 2 mandate variables, and that's the progress that we want to see. But I think people, they want to be convinced, you know, they want to be careful not to jump to a conclusion really one way or the other, but just be convinced that the data, you know, support the conclusion. And that's why, given how far we've come and how
They tried to climb back up in there, and it kind of rejected it.
we'll proceed carefully as we assess the incoming data and the evolving outlooks and risks.
Spoos are just random right now. Good grief.
And in your view, I know nothing has been decided yet, but what would one more hike at the end of the year do to the economy or to inflation? And on the other side, what would no hike do, if you could sort of game that out for us?
So, you know, you can make the argument that one hike one way or the other won't matter, but for us, we're trying, obviously as a group, it's a pretty tight cluster of where we think that policy stance might be, but we're always going to be learning from data. You know, we've learned all through the course of the last year that actually we needed to go further than we had thought. If you go back a year and what we wrote down, it's actually gotten higher and higher. So we don't really know and that's why, again, we're in a position to proceed carefully at this point. A year ago, we proceeded pretty quickly to get rates up. Now we're fairly close, we think, to where we need to get. It's just a question of reaching the right stance. I wouldn't attribute huge importance
If you think I'm a fraud, Ms.
to one hike in
Go for yourself,
macroeconomic
okay? That's
terms.
plain and-
Nonetheless, you know, we need
All right.
to a place where we're confident that we have a stance that will bring inflation down to 2% over time. That's what we need to get to, and we've been moving toward it as we've gotten closer to it. We've slowed the pace at which we've moved. I think that was appropriate. And now that we're getting closer, we have the ability to proceed carefully.
Let's go to Steve.
Steve Leisman, CNBC. Mr. Chairman, I want to return to Colby's question here. What is it saying about the committee's view of the
Okay, a couple of good down ticks there, but obviously they're going to come to where I would get filled. They're going to be reluctant to do it.
for next year, but need another 0.5 point of the funds rate on it? Does it tell us that the committee believes inflation to be more persistent, requires more medicine effectively? And I guess a related question is, if you're going to project a funds rate above the longer run rate for 4 years in a row, at what point do we start to think, hey, maybe the longer rate or the neutral rate is actually higher? Thank you.
So I guess I would point more to pointing to a sense of inflation having become more persistent. I wouldn't think that's not, we've seen inflation be more persistent over the course of the past year, but I wouldn't say that's something that's appeared in the recent data. It's more about stronger economic activity, I would say. So if I had to attribute one thing, again, we're picking medians here and trying to attribute one explanation, but I think broadly, stronger economic activity means rates, we have to do more with rates, and that's what that meaning is telling you. In terms of what the neutral rate can be, you know, we know it by its works. We only know it by its works, really. We can't, you know, the model and that the economy reacts. And again, that's another reason why we're moving carefully now, because there are lags here. So it may of course be that the neutral rate has risen. You do see people, you don't see the median moving, but you see people raising their estimates of the neutral rate. And it's certainly plausible that the neutral rate is higher than
That's what Joseph Wing was talking about.
what we write down in the SEP.
R star. What's the neutral rate?
It is certainly possible that that the neutral rate at this moment is higher than that.
Come on.
That's part of the explanation.
Come on.
for
There we
why
go.
the
Good
economy
grief.
has been more resilient than expected.
Let's go to Howard.
Howard Schneider with Reuters, thank you. So you've said several times that the economy needed a period of below-trend growth to get inflation consistently back to 2%. You kind of get that in 2024, a little bit, 1.5% is just a touch below what's the estimate of potential. So the fact that you're getting so much done at so much less cost, does that represent a change in how you think inflation works, a change in how you think the economy works, a change in the mix of supply healing versus demand destruction that's necessary to achieve this?
Yes, of course, it is a good thing that we've seen now meaningful rebalancing in the labor market without an increase in unemployment. And that's because we're seeing that rebalancing in other places, in, for example, job openings and in the jobs worker gap. You're also seeing supply side things. So that's happening.
News Squawk tweets Powell's new buzz phrase, proceed carefully. He never said that at the July FOMC, but has already said it a few times today.
Softening in the labor market come through more supply, as we've seen as well. Also, remember the natural rate we think is coming down, which is a supply side thing, so that the gap between any given unemployment rate that's lower than that and the natural rate comes down. That's a way for supplies. That's a way for the labor market to achieve a better balance. So all of those things are happening. You're right. In the median forecast, we don't.
There's 07. Seems like the little iceberging there, though.
And
Why is there so little liquidity at 06?
we've been seeing? That is not guaranteed. There may come a time when unemployment goes up more.
It's a
than
little
that, but
weird.
That's really what we've been seeing, is progress without higher unemployment for now.
So just to boil that down for a second, we've gone from a very narrow path to a soft landing to something different. Would you call the soft landing now a baseline expectation?
No.
Oh, he does not consider the soft landing a baseline, but that's what the market thinks, isn't it?
I've always thought that the soft landing was a plausible outcome, that there was a path, really, to a soft landing. I've thought that, and I've said that since we lifted off. It's also possible that the path has narrowed and it's widened, apparently. Ultimately, this may be
Seen a lot of pushback on every tick, really.
at the end of the day, but
Like they cleared it at 06.5, but there was immediately 400 contracts to push back against it. See that?
this is why we're in a position to move carefully again, that we will restore price stability. We know that we have to do that, and we know the public depends on
Okay, well,
and we know that we have to do
looks like I'm getting away with pyramiding.
labor market.
Whoa, the S&P is getting slaughtered there.
Strong labor market conditions that benefit all. We know that. The fact that we've come this far lets us really proceed carefully, as I keep saying. So I think, that's the end we're trying to achieve. I wouldn't want to handicap the likelihood of it, though. It's not up to me.
Good man, good man.
Nick Timmeros of the Wall Street Journal. Chair Powell, both you and Vice Chair Williams have indicated that sufficiently restrictive will be judged on a real rather than nominal basis, implying some scope for nominal rate cuts next year, provided further compelling evidence that price pressures will continue to subside. Is the FOMC focused on targeting a real level of policy restriction? And can you explain what would constitute enough evidence that will allow the FOMC to normalize the nominal stance of policy while keeping real policy settings sufficiently restrictive?
I mean, yes.
He asked a
we
super
understand that it's a real rate
complicated question.
that needs to be sufficiently restrictive. Again, I would say, sufficiently restrictive only when you see it. It's not something you can arrive at with confidence in a model or in various estimates, And so what are we seeing? We're seeing through a combination of the unwinding of the pandemic-related demand and supply distortions and monetary policy's work in suppressing demand or alleviating very high demand, the combination of those two things is actually working. You're seeing, inflation coming down. It's principally now in goods, also in housing services. You begin to see effects of it in non-housing services as well. So we think that is working. And I think as we've said, we want to.
No, I won't put those out there. I'll wait if it gets up there.
We're confident it gets us to that level. And I think confidence comes from seeing, enough data that you feel like, yes, okay, this feels like we can for now decide that this is the right level and just agree to stay here. We're not permanently deciding not to go higher, but we would, let's say if we get to that level. And then the question is, how long do you stay at that level? And that's a whole nother set of questions. For now, the question is trying to find that level where we think we can stay there. And we haven't gotten to a point of confidence about that yet. That's the stage of
this year. And even then, it seems possible that core PCE inflation could come in even lower than the median at 3.7%. Would you see a case to raise rates still if it turned out that you were going to achieve the same real rate this year because the decline in inflation proceeds somewhat better than you currently anticipate?
The decision that we make at each meeting, and certainly at the last two meetings this year, it's going to depend on the totality of all the
Yeah, good job, John. You called it short early. You'd been on it all day, yeah?
The balance of risks and the other events that are happening out there. We take all of that into account. So I can't really.
It's a risky play. It's one that I don't have the balls for, but
over whether
we totally called it here today, didn't we?
That will increase our confidence that yes, this is.
I don't think I've called an FOMC this spot on in a while.
Level that we need to get to.
Gina. Thanks, Chair Powell. Following up on Nick's question, actually, John Williams, the New York Fed president, obviously, has said things to the effect of next year as we see inflation, kind of, again, to Nick's point, as we see inflation coming down, we're going to need to reduce interest rates to make sure that we're not squeezing the economy harder and harder over time. And I wonder if that's basically the logic that you apply. Is that how you think about it? And then I also wonder, in the last press conference, you said something to the effect of, it's a full year out, those discussions, and people interpreted that to mean that you didn't see a possibility of a rate cut in the first half of next year. And I wonder if that was what you meant by that, or whether, how you're thinking about that timing.
No, when I answer these questions about hypotheticals about cutting, I'm never intending to send a signal about timing. I'm just answering them as the question is expressed. So please, I wouldn't want to be taken that way. Sorry, the first question was that how? Yeah, so we're, as we go into next year, that's the.
Of course, the market will always react anyways, right?
And everything else we know about the economy.
Algorithm's going to algorithm.
The time will come at some point, and I'm not saying when.
Mayor Guya, I thought the market would go up when the interest rate was expected to pause. Well, that's correct.
It'll be
but
all the factors that
we've kind of been in that environment for a couple of months now.
And what you see is us.
And now we've kind of come after the pause. And what are they saying?
There's so much.
Seems like maybe we need a little bit more.
I think makes sense. No one will look back at this and say, "Hey, we made a plan." It's not like that at all.
So now it's going to be like one rate cut in December, and then maybe another rate cut at the beginning of the next year, and then we kind of come to another decision point again. Like I would think after all of this that the chances of there being a rate hike in the next two meetings is really high now.
Is driven by excess demand versus supply side factors, productivity, labor force growth, and relatedly, if GDP keeps coming in hot, even in the absence of inflation resurgence, would that on its own be a reason to consider more tightening?
So on your first question, I mean, we're looking at GDP very, very carefully to try to understand really what's the direction of it, what's driving it, and it's a lot of consumer spending. The consumer's been very robust in spending. So that is that's how we're looking at it. Sorry, your second question was?
There's GDP stays hot, but without inflation.
So I think the question will be, GDP is not a mandate, right? Maximum employment and price stability are the mandates. The question will be, is GDP, is the heat that we see in GDP, is it really a threat to our ability to get back to 2% inflation? That's going to be the question. It's not a question about GDP on its own. It's, you're expecting to see this improvement, continued rebalancing in the labor market and inflation moving back down to 2% in a sustainable way. We have to have confidence in that. We'd be looking at
I kind of feel like somebody just gave it up there.
one or both of those.
Still looks like currency driven.
Hi, Victoria Guida with Politico. There are multiple external factors that are playing out right now. We see rising oil prices. We see auto workers striking. There's the looming, very real possibility of a government shutdown. And I was just wondering, for each of those things, could you talk about how you're thinking about how that might affect the course for the Fed and the economy?
So there is a long list, and you hit some of them. But it's the strike, it's government shutdown, resumption of student loan payments, higher long-term rates, oil price shock. There are a lot of things that you can look at. So what we try to do is assess all of them and handicap all of them. And ultimately, though, there's so much uncertainty around these things. I mean, to start with,
Still takes a lot of contracts to push them down when they do go.
On the strike, as we have no view on the strike one way or the other, but we do have to make an assessment of its economic effects to do our jobs. So, the thing about it is so uncertain. It will depend. The economic effects, it could affect, we've looked back at history, it could affect economic output, hiring, and inflation. But that's really going to depend on how broad it is and how long it's sustained for. And then it also depends on how quickly production can make up for lost production. So none of those things are known right now. It's very, very hard to know. So you just have to leave that uncertain. And
There's quite a jump in the activity when you started talking about the strike, wasn't there?
Next intermeeting period. It hasn't traditionally had much of a macroeconomic effect. Energy prices being higher, that is a significant thing. Energy prices being up can affect spending. It can affect over time. A sustained period of higher energy prices can affect consumer expectations about inflation. We tend to look through short-term volatility and look at core inflation. But so the question is, how long are higher prices sustained? We have to take those macroeconomic effects into account as well. Those are some of them. I'm not sure if I hit them all, but ultimately, you're coming into this with an economy that appears to have significant momentum, and that's what we start with. But we do have this collection of risks that you mentioned.
Craig Torres from Bloomberg News. I was a little surprised, Chair Powell, to hear you say that a soft landing is not a primary objective. This economy is seeing added supply in a way that could create long-term inflation stability. We have prime age labor force participation moving up where people can add skills. Workers want to work. We have a boom in manufacturing construction. We've had a decent spate of home building. And since inflation's coming down with
I believe the biggest players already know the Fed's play.
which good for the Fed.
I mean, if they did, they would have had different pricing going into the meeting, wouldn't they?
Aren't we opting for the awful history?
Although it is kind of interesting and I guess fortuitous for the CTAs and everything that they ended up being short going into this.
A soft landing is a primary objective, and I did not say otherwise. I mean, that's what we've been trying to achieve for all this time. The real point, though, is the worst thing we can...
I might be interested in see if that guy is at the next meeting, because I feel like he kind of got reprimanded there.
You can have a long period where the economy is just very uncertain, and it'll affect growth, it'll affect all kinds of things. It can be a miserable period to have inflation constantly coming back and the Fed coming in and having to tighten again and again. So the best thing we can do for everyone, we believe, is to restore price stability. I think now, today, we actually, we have the ability to be careful at this point and move carefully, and that's what we're planning to do. So we fully appreciate that, the benefits of being able to continue what we see already, which is rebalancing in the labor market and inflation coming.
Interesting lot right there. Somebody wants to get filled at 5083 in the 2-year.
Employment, which has been typical of other tightening cycles.
I'm kind of tempted to fill him.
Hi.
Go on out. Okay.
Gabriel, Associated Press. When you look at the disinflation that has taken place so far, do you see it mostly as a result of what some economists are calling the low-hanging fruit, such as the unwinding of supply chain snarls and other pandemic disruptions, or is it more about
Looks like we're at the low of the range again and pushing lower.
that involves most goods and
We
services?
still got like the 03 area to take out.
So if I understood your question, I would say it this way. I think we knew from before when we lifted off, but certainly by the time we knew that bringing inflation back down was going to take, as I call it, the unwinding of these distortions to both supply and demand that happened because of the pandemic and the response. So that unwinding was going to be important. In addition, monetary policy was going to help. It was going to help supply side heal by cooling demand off, and just in general, better aligning.
I wouldn't pay $1 million to make that.
So
There's still. I think that there probably are leaks.
very hard to pull them apart.
Sure.
Together. I do think both of them are at
How widespread they are, I don't know.
a way that shows you the progress that we are seeing.
I don't know if in this case you really needed leaks to know. Like,
Michael McKee from Bloomberg Television.
no.
In June, you forecast a
Going into this, I thought that the expectations that I was seeing seemed off. But I've very often seen on many cases, and I wouldn't say that this is so much a thing post-pandemic, but I can remember back when I first started trading, there was times where there would be a morning move, like the treasuries that morning would have this huge trend that seemed to coincide with what the actual result of the Fed meeting was. And so there's almost, without question,
What's happened is growth has
leaks.
been stronger, right? Stronger than expected. That's required higher rates.
The thing that I would not agree with is the idea that we can just watch
Is not as high.
what the market is doing beforehand and predict from the market activity what the result is going to be.
We're continuing that.
Because I've seen plenty of times where there was behavior that it seemed like there could have been a leak and it was just like dead wrong.
Good readings. It's only 3 readings,
And beyond that, I see a lot of situations where
declines in core inflation.
the market just does not do what you would expect it to do, even if you knew what the result was going to be, even if you knew what the Fed statement and everything was going to be, and you called it all correct, and you might get what the market ends up doing wrong.
I think,
and quite frankly, there's a lot of this market movement that you get on these days that is just random noise. Like you got every day trader sitting there with an itchy trigger finger waiting to do things. The market ends up doing really bizarre, irrational stuff in that situation.
Given the forecast
So
that you have, what justified not moving?
I think that some people overestimate what a large bank like a Goldman might do if they had a leak.
I think we have come very far, very fast.
It doesn't actually change
that we've made.
Their behavior
It was important
as much as you might think.
quickly, and we did. And I think as we get closer to the rate that we think, the stance of monetary policy that we think is appropriate to bring inflation down to 2% over time,
Short on the 15th?
become more two-sided. And the risk of over-tightening and the risk of under-tightening that becomes.
Nah.
I think
Trying to remember what happened on the 15th, though.
is as you approach that, you move a little more slowly.
That was Friday.
That's what
I don't.
We're taking advantage of the fact that we have moved quickly to move a little more carefully now as we sort of find our way to the right level of restriction that we need to get inflation back down to 2%.
That was the CPI on 13.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance.
Now, what was on Friday?
Your PCE. Isn't it true that base
Pretty
effects
sure there was news that day, though.
and that by the time you meet in November, that it's more likely that you'll have a low PCE number that would make you feel more comfortable? And secondly,
Consumer sentiment.
key indicators like CPI and the jobs report impact your approach in upcoming meetings if we
I think that the CTAs have probably been short all week.
the base factors.
Base factors, okay. So
You got to understand how momentum strategies work, right? They're just looking at a basket and going long the ones that are doing the best and short the ones that are doing the worst.
base factors, but we can adjust for that. In terms of not getting data, again, we don't comment on government shutdowns. It's possible if there is a government shutdown and it lasts through the next meeting, then it's possible we wouldn't be getting some of the data that we would ordinarily get, and we would just have to deal with that. And I don't know. It's hard for me to say in advance how that would affect that meeting. It would depend on all kinds of factors that I don't know about now, but it's certainly a reality that's a possibility.
As those kind of fall out of the equation for the next couple of readings by November, would you feel more comfortable at that point?
Yes. I mean, if you're looking, we can tell how much inflation has gone up in a given month, right? And that's what we're looking at. And month by month, what's the reading? And I think what we're really looking at is there's a tendency to look at shorter and shorter maturities, but they're incredibly volatile and they can be misleading. That's why we look at 12-month. But I think in this situation where it looks like we've had a bit of a turn in inflation starting in June, we're also looking at 6 months and even 3 months, but really 6 months inflation. So you're looking at it over that period and over longer periods. That's the right way to go. And we don't need to be in a hurry in getting to a conclusion about what to do. We can let the data evolve.
Thanks for the question, Chair Powell. Edward Lawrence with Fox Business. So I want to focus back in on oil prices. We're seeing oil prices, as you mentioned, move up, and that's pushing the price of gas. So how does that factor into your
Big
decision
bid 06A.
rates or not? Because the last two inflation reports, PCE and CPI, we've seen the overall inflation has actually risen.
Right. So, energy prices are very important for the consumer. This can affect consumer spending. It certainly can affect consumer sentiment. I mean, gas prices are one of the big things that affects consumer sentiment. It really comes down to how persistent, how sustained these energy prices are. The reason why we look at core inflation, which excludes food and energy, is that energy goes up and down like that, and it doesn't. Energy prices mostly don't contain much of a signal about how tight the economy is, and hence don't tell you much about where inflation's really going. However, we're well aware, though, that if energy prices increase and stay high, that'll have an effect on spending, and it may have an effect on consumer expectations of inflation and things like that. That's just things we have to monitor. So.
On the consumer, they're putting more and more of this on their credit card. The consumer seeing a record credit spending. How long do you think the consumer can
Order moved.
debt at higher interest rates now? And are you concerned about a debt bubble related to that?
So to finish my prior thought, I was saying that's why we tend to look through energy moves
Picked up.
that we can see as
There's two big bids there at 05, half and 05.
Turning to consumer credit, of course, we watch that carefully. Consumer
Have first one pulled.
stress among consumers
First one pulled.
flows quite
You
recently
gonna pull it 05 too?
during and after the pandemic.
Come on.
Now moving back up to normal. We're watching that carefully.
Moves down.
At this point, these readings are not at troublingly high levels. They're just kind of moving back up to what was typical in the pre-pandemic era.
Hi, Jean Young with M&I Market News. Yields along the Treasury curve have risen to their highest in years. What is the Fed's view about what's been driving that increase in recent weeks, and how much of it can be attributed to macro explanations and how much to technical factors?
So you're right. Rates have moved up significantly. I think it's always hard to say precisely, but most people do a common decomposition of the increase, and the view will be it's not mostly about inflation expectations. It's mostly about other things, either term premium or real yields, and it's hard to be precise about this. Of course, everyone's got models that'll give you a very precise answer, but they give you different answers. So, but essentially, they're moving up because it's not because of inflation. It's because it'll probably have something to do with stronger growth. I would say more supply of treasuries. The common explanations that you hear in the markets kind of make sense.
Kyle Campbell, American Banker. Thank you for taking the questions. Just two on housing. You've said slower shelter cost growth is in the pipeline and will reflect in inflation readings as new leases are signed. But there's also some questions out there about the way housing costs are measured, particularly the use of rental equivalents, which are estimates from homeowners about what their homes would be in the rental market. So my question is, how much of the effort to tame inflation, both as it's measured and felt by the broader public, hinges on housing supply? And then as far as a constrained housing supply being sort of exacerbated by this sort of lock-in effect of mortgages being higher now than they were at their recent historic lows, how is that going to impact future thinking about taking interest rates to that lower bound in the future?
So on the supply point, of course, supply is very important over time in setting house prices and for that matter, rents. And so
There you go.
And supply is.
Well, there was some liquidity at 26, so I think that some of that liquidity looking to buy there was serious.
As you obviously know, a lot of it is leases that are running off.
Nah, see,
Re-signed.
now you're talking, John. Now you're talking about stuff that I just don't care
level
about.
that's it won't be that much higher. It would have a year ago it would have been
Chart patterns, all this.
Now it may be below
No evidence it works.
So as those leases are rolling over, we're seeing what we expect, which is measured housing services inflation coming down. Your second question was the lock-ins. How much is that affecting things, really?
Is that going to affect your decisions to potentially bring rates down to their lower bound in the future, sort of creating that sort of bubble of buying and then a lock-in that sort of stagnates the housing market?
I think we look at I would look at the lock-in, the idea being that people are in very low.
I think we're getting those big trades there in the 05 area were for real, and so we're kind of getting a little bit of shifting around because of that. Sure is buffering a lot today, isn't it?
It would be hard because the new mortgage would be so expensive. Play a role in
There's a big bid at 05 half again.
In a future loosening cycle. About whether we would cut rates, no, I don't think it would. I mean, I don't think that's. I think we'd be looking at what fundamentally what rates does the economy need, and in an emergency like the pandemic or during the global financial crisis, you have to cut rates to the point that you have to do what you can to support the economy. So I wouldn't think that would be a reason for us not to do that. It's not something we're thinking about at all right now, but down the road I wouldn't think so.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you've mentioned several things that would possibly weigh on consumer confidence, maybe cut back consumer spending, possible government shutdown, high gas prices. At this point, would the Fed welcome a decrease in consumer spending? Would that help you get inflation closer to your 2% target?
I wouldn't say it that way. We're not looking for a decrease in consumer spending. It's a good thing that the economy is strong. It's a good thing that the economy has been able to hold up under the tightening that we've done. It's a good thing that the labor market's strong. The only concern, and it just means this: if the economy comes in stronger than expected, that just means we'll have to do more in terms of monetary policy to get back to 2%, because we will get back to 2%. Does that answer your question?
Yeah, and I guess on the other hand, would you worry that that could contribute to an economic slowdown or even a recession?
Well, that's always a concern. I mean, concern number one is restoring price stability, because in the long run, that's something we have to do so that we can have.
Okay, coming back down again.
Which is one with sustained period of tight labor market conditions that benefit all, as I've said a couple times. So that said, of course, you know, we also now, given how far we've come with our rate hikes and how quickly we've come here, we do have the ability to be careful as we move forward because of that consideration.
Thank you, Chair Powell. Simon Rubinovich with The Economist. One of the factors in the economic resilience to date appears to be a lesser degree of rate sensitivity than in the past. Obviously, we've talked about households with long fixed rate.
Now, big order shows up at 03 half?
Before last year. What is your thinking about the efficacy of rates and how that's changed?
And then, very curious.
How do you think about the distributional
Lots of odd big orders in here. I should add that we're already past the pit close in the treasuries.
It's not been all that tough with rates going
Oh, they're going to go now?
Your credit card for supporting your consumption. In fact, times are getting a lot tougher.
I said it was at 04, right? It's not there.
So what?
They pulled.
I guess it's fair to say that the economy's been stronger than many expected, given what's been happening with interest rates. Why is that? Many candidate explanations. Possibly a number of them make sense. One is just that household balance sheets and business balance sheets have been stronger than we had understood, and so that spending is held up and that kind of thing. We're not sure about that. The savings rate for consumers has come down a lot. The question is whether that's sustainable. That could just mean that the date of effect is later. It could also be that for other reasons, the neutral rate of interest is higher for various reasons. We don't know that. It could also just be that policy hasn't been restrictive enough for long enough. And there are many candidate explanations. We have to, in all this uncertainty, make policy. And I feel like what we is what's still a very strong labor market, but that's
so
we were making progress on inflation.
Not quite there. I need another 2 ticks.
Many forecasts call for growth to moderate over the course of the next year. So that's where we are.
So if I get my 2 ticks, should I take some off? I think I should.
On your second question your second question was distributional, but can you be a little clearer about that?
Yeah, my point there was that if you're somebody who has a long fixed rate mortgage, you've been able to endure the higher rates relatively easily. If you're somebody who's living month to month off of your credit card, current financing rates are punitive.
Yes, and so the point I would make there is that we're trying to get inflation back down. The people who are most hurt by inflation are the people who are on a fixed income. If you're a person who spends all of your income, you don't really have any meaningful savings. You spend all your income on the basics of life: clothing, food, transportation, heating, the basics. And prices go up by 5, 6, 7%. You're in trouble right away. Whereas even middle class people have some savings and some ability to absorb that. So it is for those people, as much as for anybody, that we need to restore price stability. And we want to do it as quickly as possible. Obviously, we would like to do that. We'd like the current trend to continue, which is that we're making progress without seeing the kind of increase in unemployment that we've seen in past things. But you're right, though. When we raise rates, people who are living on credit cards and borrowing are going to feel that more. They are. And of course, people with lots of savings also have a much lower marginal propensity to consume, and so it's not going to affect them as much.
Let's go to Greg Robb for the last question.
Thank you, Chair Powell. Greg Robb from MarketWatch. In the Beige Book recently, you can tell that the Fed has been surveying nonprofits and community groups about the economic health of low-income Americans, moderate-growth Americans. I have 2 questions about this. Are you going to use that data to maybe come up with sort of like a quarterly survey of those groups, like the senior loan officer?
When did I lose my faith in things like patterns?
And also the second question is, from your recent readings of
when I started back testing them.
Low and moderate Americans doing, is there this thing where like the GDP is strong because of wealthy Americans kind of driving things. And just want to get your sense of the health of
Once, so for a long time, I worked at a bank and I learned a lot of stuff about technical analysis on my own while I was there. And then when I started talking to the traders, when I finally had the opportunity to talk to the traders, they didn't know shit about any of those patterns. And that was the first thing that kind of made me go like, So then when I left the bank and I had the opportunity to start using tools like NinjaTrader and backtesting them, and I run my own backtests, and I found that, yeah, there was like no efficacy to any of the tools that were popular whatsoever.
Wages, and you're starting to see real wages are now positive by most measures. So I think overall households are in good shape. Surveys are a different thing. So surveys are showing dissatisfaction, and I think a lot of that is just people hate inflation, hate it. And that causes people to say the economy is terrible, but at the same time, they're spending money. Their behavior is not exactly what you would expect from the surveys. That's kind of a guess at what the answer might be. But I think there's a lot of good things happening on household balance sheets, and certainly in the labor market and with wages. The biggest wage increases having gone to relatively low-wage jobs. And now inflation coming down, you're seeing real wages, which is a good thing. Thanks very much.
Is that the end? I guess that's it. I feel like that kind of ended a little abruptly, you know? Well, let's make sure New Squawk is turned back on here first of all. Spoos. Ending all of that down 35 points so far on the session. Treasuries also kind of drifting down towards the lower end of that, although they seem to be catching a little bit of a relief with Powell ending his speech. There is a pretty big order there at 04. Can you explain the imbalance between the DOM and delta that you look for? Okay, well, how did you learn to start trading things like the yield curve and trades, etc.? Which sources did you use? Man, I really wish that there was like one resource I could give you that would teach everything that you know. I tried to put like the most major and important stuff in both my video on trading treasuries and trading the Federal Reserve and trading the news. And so there's 3 videos right there. And then I have the little strategy PDF. If you go to speculatorseth.com/strategy.html and put your email in, it will email the PDF to you. Should probably do some work on that. Make it, beef it up a little bit, make it more pretty and stuff. But that gives a lot of the hard information that you need on these sorts of things. But how did I acquire it? Just coming in every day and reading the financial news and reading books and studying about this topic for 15 years now. So, yeah. Oh, you didn't know about the PDF? Yeah, that one I think really helps. I think the thing that I think is really important about the PDF is that I think that the PDF paints a much better picture of how you can utilize the stylized behaviors of markets that we know about to your advantage, like actual tactical factors that you could use in your trading with it. Yeah. And the way that I learned most of the stuff about the stylized behaviors of markets, most of that is basically just my application of what you learn in Trades, Quotes, and Prices. Because this book is basically like, this is what we know about markets. This is all of the data. And I'm basically just taking it and showing you the important parts of it and what it means for us. That's all that is. Dude, you don't understand. I didn't come up with this shit. I really didn't, okay? It's just astounding to me that there aren't other people in the trading community, like on YouTube or what have you, that are sharing this information. But it's just like not there, because what happens is anybody that cares works for a bank, and they're not allowed to talk about it. And I just happen to be this really bizarre by chance aberration where I was close enough to be able to kind of know vaguely about what research they were talking about so that I could go and find it on my own afterwards. But I wasn't inside enough that like I wouldn't be able to talk about it. Right. Yeah, that book is tough. It is tough. Just that's one of the things that you just push through it, like, because you won't understand all of the math the first time, but they do a really good job of kind of digesting for you down at the end of the chapter. Okay, what is it that we actually learned here? It's really good. Sometimes I read this book and wonder what a genius. Yeah. The people that wrote that book is a genius. The people that found that stuff, they are geniuses, man. I never would have. Of course, a lot of it comes down to that they just had access to data that we don't. Okay, but it just absolutely brilliant work. And again, it's just so nuts that we've known about a lot of this stuff since the 80s. Like, this is the stuff that basically transformed the trading world in the 80s after the 1987 crash. Nobody in the retail world talks about it. It's so nuts. But I didn't come up with it. Okay? This is based on real empirical research from like, you know, researchers that do this for a living and know what they're talking about. And I just have the great privilege of being the guy on YouTube that gets to relate it to you because they can't. You know? Well, do you know where I get the code that does pattern recognition in C# for Ninja? I can code in C#, but I prefer not to have to reinvent the wheel. Well, so if you want to like do a head and shoulders pattern, for instance, if you're looking for something that will show me a head and shoulders pattern on a chart, I am not aware of an indicator for NinjaTrader that does that straight up. Name of the book, it's called Trades, Quotes, and Prices, Financial Markets Under the Microscope by Jean-Philippe Bouchot, Julius Bernard, Jonathan Donier, and Martin Gould. This guy right here, Jean-Philippe Bouchot, he is somewhat active on LinkedIn. This guy is the fucking man, dude. Like, if you're looking for, okay, because this is the way that most people kind of approach something, is they say, I need to have a hero. I need to have somebody that I'm going to like emulate, and that's their work is going to be, they're going to be my idol. Okay? Don't idolize people. They'll always disappoint you. Okay? But if there's anybody that is actually like worthy of our admiration in the industry, I think it's Jean-Philippe. Oh, you actually spoke with him? Really? That's cool. Yeah, I've chatted with him once or twice on LinkedIn, but I try not to bother him. So don't go bother him, guys. But man, some of his work is just amazing, and his career is just amazing, because this guy, he got together with a couple of other people and co-founded Capital Fund Management, which has the most generic name for a fund management ever. Okay, but they are like the leaders in this space. Like, if you want to do a CTA momentum type strategy, they have the best one. Like the hedge fund awards, they're the ones that are winning all of the hedge fund awards. It's kind of like, again, here it's like super crazy. So I'm reading this going on today. I don't like talking about this stuff because it exposes me to harassment, but there's this guy named Iman, I think it is. Iman Trading. He's become successful relatively recently on YouTube because he made a couple of YouTube videos trying to expose people that he felt were being dishonest on YouTube and social media about their trading results. And so he put out a video about Inner Circle Trader, who has become a really big deal on YouTube. Like there's a whole like if you search for ICT, there's like a whole group of creators that make content about ICT now, trying to teach this way of trading to you. And I'm gonna make my own video because I went and I back tested their setup too, and that there's some it doesn't work. There's some really interesting things about it though that teach us stuff about the markets that I think are really important to know. So I'm hoping I can like really nail down what I want to say by Saturday so that I can record it this weekend and maybe try and take advantage of that thing. But I'm reading these comments over here, and there's a bunch of people talking about, oh yeah, I remember when I first saw the video with ICT and Vinny and all these other people. Like these are the people that your typical retail day trader, they're looking at, they're talking about, they're thinking about, and it's just a racket. Like there's absolutely no efficacy to what these people. The whole theory is complete bunk based on our real empirical understanding of markets. What they're saying, it's complete bunk. It's complete bunk. Why is it that retail traders, they hear about ICT, they don't know who Jean-Philippe Bugeaud is? Oh my gosh, like it just makes my head hurt trying to wrap my mind around how the retail side of an industry could become so utterly misinformed about the markets. Is just nuts. It's just nuts. Anyways, I got off on that tangent. I didn't finish answering John's question. So I've never found an algorithm in NinjaTrader that will be like when a head and shoulders pattern appears on a chart, it will highlight it for you, that sort of a thing. I have found that for Python, and so you could probably adjust to it. That makes you could probably adapt it into C#. Okay. I've never bothered going into the patterns sort of a thing because number one, there's been a lot of studies out there about patterns. In the head and shoulders pattern in particular has been studied like really extensively. And there's even like, I think there's even a study from the Federal Reserve about head and shoulders patterns that basically said it didn't work. But there was another study that basically said, what happens if we turn the same kind of machine learning algorithms that we use to like draw things, you know, like DALL-E 2 and that sort of a neural network that we can use to like make original paintings. What happens if we put them on a picture of charts? We train them on all of these charts, and then we show it the chart and we ask it to finish the chart and tell us what's going to happen next and trade based off of that. And they tried that and it didn't work at all. Didn't work at all. So that's why I never went and bothered putting the work into making a back test that like would test a head and shoulders. The ones that I've tested, well, I've done a lot of stuff with all of your like we would call it like data series type indicators like RSI, moving averages, that sort of a thing. That's where I spent the most amount of time. But I have also done things that would, I guess you could kind of consider like patterns. So like the one that for the smart money concepts that I'm going to be showing you guys in a week or two is there's a key level. It goes below the key level. There's a key level. It goes below the key level, comes above the structure from before the move, and then comes back to a fair value gap of some sort, and then moves higher. That's the setup that they do. This you can backtest because there's the zigzag indicator in NinjaTrader. So I can determine, okay, it pivoted. We went below the key level, it pivoted. What was the price? What was this? What's this price? I can identify that essentially. And I can identify where the fair value gap was and everything. So I can basically just put a limit order out there waiting for the fair value gap to get cleared and try and go long off of that. And that's what that strategy does. And it works. And you'll see it in the pattern and everything. The backtest results that you get, they are not random. I put you that. It's not profitable, but they are not random. Okay. It's a really, really interesting result that I got from that. But yeah, don't trade it. Doesn't work. The long and short of it is don't trade it. It doesn't work. Oh yeah, so it was Zeta was the one that he asked the question and I didn't get to. I don't know if you're still there, Zeta, but you were saying talk more about the imbalance between the DOM and the delta that you were looking for. Okay, so let me see if I can try and explain this. There are 6 fundamental forces in the market, and they basically, these 6 fundamental forces correspond to 6 actions that you can take. Okay, because if I can come in here, I can put a limit buy, right? I can put a limit sell. Or I could click on the current best bid offer, and that would be a market buy and a market sell. The other thing that I could do is when I put a limit buy, for instance, I have the limit buy down here at 02, I can cancel that. Okay. So what you can do is you can go and look at participants and saying on a 15-second time period or whatever kind of granularity you want to look at it. How many actions of each of these are happening? Okay. How many bids are being added? How many bids are being canceled? How many market buys are happening? How many market sells are happening? Okay. It is the interaction of these 6 things that basically determine what price does. Okay, now that interaction can kind of become a little bit complicated, but the gist of it is this, okay? If there are a lot of people adding limit buys onto the, into the market, then that's going to tend to make price go up. If people are placing limit sells, that's going to tend to make price go down. If people are market buying, that's going to tend to make the market go up. If they are market selling, that's going to tend to make the market go down. Vice versa. I mean, that should all be pretty straightforward, right? And then the other one is if they cancel. So if bids are canceling, that's going to tend to make the market move down. Okay. So then there's kind of like these different scenarios, like price, all of the limit orders cancel and then price ticks down. So maybe it was only 500 contracts for it to trade down, but because all of the limit orders canceled, we were able to move down. And what causes price to move is when those market orders overcome the amount of liquidity available at that price. So in order for price to tick down right now, there's 2,500 contracts on the bid that would have to be filled. So you would either need more than 2,500 market sell orders, or some of those 2,500 market buy orders at 04.5 would need to cancel. Right? Okay, so when I talk about an imbalance, one of the things that I'm most interested in is the market orders. The market orders are the aggressive orders. Thank you. My wife just brought me a sandwich, and I'm like, it's been 2 hours. I don't know what's going on, but it sounds to me like she's been having difficulties outside, so I'm not going to give her shit over it. So the market orders are really important because that's kind of like the best indication that we have of like what informed traders are doing, right? Like if you know something, if you know something and it's going to overall move the market, you can't necessarily, other people might find it out soon. So you don't necessarily just want to sit around and wait with your limit order in case maybe it comes all the way down here and you get your, no, you're gonna hit it with market orders. Okay, so the market orders tend to be not predictive, but in line with where the price is going, right? So if we move up, I'm gonna tend to see that there were more market buys than there were market sells, right? Now, when there's a meta order going on, what's going to happen is that imbalance between market buys and market sells is going to be persistent. Because what the market data suggests is that there is a strong autocorrelation with the sign of orders. If you're seeing buying out there in the market, it's very likely that you come back an hour later, you will still see buying. And this is a statistical result that is very consistent across markets that is not in line with what a completely random market would be. Okay. And they did a bunch of studies like, okay, why does this happen? Because everybody thinks that it happens because we're all just following each other, right? But when they used, like, I think they call them propagator models, these sorts of things that would be like, okay, this one gets triggered by this one, and then that's buying maybe triggers other people. And when they kind of use that is not how the market moves. Like that they modeled it and it didn't match the stylized behaviors of markets that we actually see. So then they went and they said, well, what if it's large meta orders? What if the reason that you see that autocorrelation for such a long time is just because a really, really big guy is buying and it just takes him all day to do it? And when they started modeling that, then they were able to start seeing some of these stylized behaviors of markets. And the most interesting one being the square root law. And so then that was the point at which the way they discovered the square root law was then they went to the banks and they said, hey, we know that sometimes you will execute these orders that take all day to execute. So what we want is we want you to show us that your order flow when you did that. Like, show us all of the orders on a day that you did that, and then we'll study it. And so they studied it, and then they found that, oh, the impact of these orders tends to follow a square root law, and that's where it came from. Right? Okay, so that's what I mean by that persistent imbalance. I'm looking for a large meta order that's going to create a persistent trend that's going to last hours that I can try and jump on. And I want to jump on that before it's obvious that a meta order like that is out there. I want to predict the meta order. I want to know stuff that will predict that somebody's going to have to execute a meta order like of that nature, right? So I'm not trying to use past market action at all to make my decision. But if I'm correct, I should see that persistent imbalance between the market buys and market sells, right? And so if I start to see a little bit of that imbalance and I want to go short, I just kind of wait until I see enough flow out there acting on that, and then I get on board. Okay. And I do that by both looking at the cumulative delta and watching the DOM. And when I'm watching the DOM, I'm looking at, okay, it ticked down. How much did it take? Right. I can see now that we've traded down from here. There was a 3K at 04 half, but then after that, they came back down here pretty quickly, didn't they? Right. So I can see that some of these bids are canceling essentially, and that there's a lot of market orders to sell here. And it kind of looks like they might just continue to sell into the close. The S&P 500 sure looks like it's going to sell into the close, hasn't it? Although, we usually aren't here at this time of day. So if you've never seen one of these streams before, I'm gonna let you in on a piece of information that not all retail traders know about. Okay, this is super important if you're going to trade E-minis at this time of day to know about. The New York Stock Exchange has something called a closing auction. Basically, what happens is you can submit orders that will be executed on the close. And everybody submits their orders ahead of time, and then when the closing auction happens, they all get matched up against each other. Okay, and you can actually see these orders before that time. You can see how many market on close orders there actually are. There's a fly flying around in here, okay? But there is a cutoff. At 10 minutes before the close, the cutoff for market on close orders comes in. And at that point, we can then look at the imbalance and see how many orders there are out there to buy or sell on the close. And that can sometimes lead to it. Like if it's $1 billion, if there's like 2 billion to sell, that you can see the mini sell off of that. So in about 2 minutes, you might see here on the S&P 500 DOM a kind of an odd little spike in activity as the robots react to the final market on close orders. Can you send me a link to the Python? I would have to go and do it's a deep dig to find that. I'm sure that if you start searching on it for Python that you would find one, but I'm pretty sure that there's a library of some sort out there, but it's not something that I've messed with because, I did all this other back testing that's like, that doesn't work. And all of the information that I have suggests that this would, the patterns wouldn't be any more effective. So people had already done that research. So I was like, okay, well, I'll mess with it then. 10-year and 5-year have pushed new lows. 30-year has not. I'm feeling pretty good here that, I don't know. I had to pyramid to do it, right? I had to pyramid to do it, which is super risky, and I don't think I would ever do it on my live account, but hey, we're pushing lows in the end. I was right, yeah? I need to eat some food. You guys, I'm sure you have some other questions, and we've only got about 10 minutes left, so I'll try and answer any other questions that you have. Where can you see the closing bell auctions or the closing auction orders? So the way that I see it is Financial Juice. Financial Juice will report it. Yeah. Big order at 01. Oh, whoa. Oh my gosh. Oh, wow. Okay, so they just told me 1.7 billion to sell. That's a lot. That's a lot. That might already be accounted for in this selling that we've had here. But that's a lot. That's a lot. This used to be something that I didn't know anything about until the pandemic, because basically what happened was they closed the floor, because when they had the floor, traders could kind of talk and coordinate and be, like, oh, we're doing this. And so they kind of knew what was going to happen. When they closed the floor, they didn't have that, in face-to-face interaction. And so in the beginning, when the final market on close orders came in, there was always like these huge moves. Like we were getting like 10-point moves initially, and that's how I learned what it was. 1.7 billion to sell is a lot. I guess it's not like it's crazy considering it's an FOMC day, but 1.7 billion to sell is a lot, and I'm sure that a lot of the downside action that we've seen was related to that. I should also note that big order that I was kind of going oh wow about. Do you see it? Do you see here on my little market depth tape? This is one of the tools that I sell on speculatorseth.com. An ask was stacked on 10, which was the inside offer, by the way. Then they canceled it, and they had to put it at 0.0 half, one tick down. But then that also canceled, and we have since ticked up. So there was a big spoof down there. That's unusual. I'm really mad that there's a fly in here now. Good grief. I need to take a bite of my sandwich. I'm so hungry. it seems to me that this 109 even price is a pretty significant price in the treasuries. There's probably a lot of people watching it. You know, it's kind of like support before in August, so I guess it would be almost poetic if we closed the day there. I think, should I leave 2 on? I think what I'm going to do is on this sim trade that I have, I'm going to just leave the other 2 contracts because I think that we could probably see some more downside tomorrow. I'm reading through on Twitter. People seem to be particularly interested in Powell's comment about the neutral rate. And he said, like, it may be that the neutral rate is risen. You don't see the median moving, but you do see people raising their estimates of the neutral rate. You do. Yep. Vincent Deluard on Twitter says, unpopular opinion, Powell was very sharp today and the questions were rather smart. There were much more advanced questions today than there usually are. This is a different league than the ECB press conferences. This does not change that the Fed made a mistake in March during the SVB crisis and a huge blunder by overstimulating in 2021. This does not change that the Fed made a mistake during this. Yeah, I probably would agree. Holy crap, they sold that. Jeez. There wasn't any more big orders involved in that, but a big old two 3K orders came in and smashed us there. That kind of looks like somebody trying to do a level break, like get some stops triggered, or maybe somebody stopping out. And we still got like 4 minutes to go. I know. See, that 4 ticks down that we had there, this close to the equities close, that sort of a thing, I think spells what that says to me is that big players actually have a lot to do now. I kind of thought when the meeting happened and everything that like they were underreacting. And now we're kind of getting some signs of like really big orders coming in and everything. it kind of looks like the big players have stuff to do. I would expect that they would need to sell. I would expect the interest rates need to go a little bit higher here, and that 3.4 could be in our near-term future, right? So, seeing those big orders going into the close, I think kind of reinforces that we might have a busy day tomorrow. Okay, well, you know what? I would like to stick around and watch all of the, everything go everywhere, but I've got another meeting coming up here, so I'm going to step out 2 minutes early. No, I'm not going to step out. I'm going to watch the last 90 seconds. For you guys, I'm going to watch the last 90 seconds, but then we got to, immediately stop, right? Because this close is going to be pretty wild to see on the Dom. This close is going to be pretty wild to watch on the Dom. Shoo fly, don't bother me. I really hate flies. I sound so autistic saying that. I really hate flies, guys. One minute. What am I, well, it's Fed day. Okay, here it is. Here's the close. Look at that. You know what? That was actually relatively tame for any mini close. I'm gonna leave this short on. I will see you guys tomorrow. It's just simp, by the way. I just want to make that clear. But I'll see you tomorrow. In the meantime, stay excellent, team.